Helping us navigate through the volatility today will be two colleagues of mine. The first is Chief Investment Strategist Boon, whom some of you might know as Simon. He has 28 years of banking experience under his belt and is excited to share his contrarian views. Jeremy Ng, our market strategist, will be sharing with us important data points which he has amalgamated into his personal recession tracker.
The question on just about everyone's mind now is whether this has been the shortest bear market in US history. To recap, the S&P 500 fell 36% from 19th of February to 23rd of March. Then it bounced 31%, leaving the S&P 500 as of yesterday net negative by only 15%. The short answer to that question as to whether this is the shortest bear market in history is no. The event here is COVID-19, and that is, once this event is over, the argument goes, we can all live happily ever after again. A few problems with this line of thinking. The first problem is that COVID-19 has been the most infectious virus to have hit the world in modern times. More infectious than the Spanish influenza. So after the infection curves have flattened, economies will likely maintain some restrictions on movements and interactions. Borders will almost certainly remain closed. On and off lockdowns are a possibility as second, even third waves of infections emerge. The second problem with this line of thinking is that this pandemic has come at the end of long economic and market cycles. During the last cycle, central banks pushed interest rates to zero or negative. Before they had a chance to normalize, we are back to zero and negative again. Government and corporate debt levels are much higher. US government debt has gone from 55% of GDP in year 2000 to 100% of GDP end of last year. Japanese government debt, debt to GDP has gone from 100% to almost 250% over the same period. US corporate debt has gone from 6.6 trillion US dollars in 2008. That was 44% of GDP. Today, end of last year, it was 10 trillion US dollars. That's 48% of GDP. But worse than that, the quality of that debt has gone down dramatically. Low rating BBB credits accounted for around 20% of the global stock of investment grade bonds in year 2000. Today, it's half of all investment grade bonds, 50%.
We'll then show you the reasoning why we are so convinced that we are right now only in the early stage of this bear market as well as recession, and probably further severe sell-off is bound to happen. So this is a list of indicators that I devised myself. I have a more extensive list, but this is just a more dense down version of the list that shows you what the data are showing. So over here, we have a list of market data as well as economic data. And what I did over here is I went back in history and tracked how this data actually signaled to us the market peak in the S&P 500 index, as well as how these indicators signal to us recession before it happens. So as you can see over there, the second column there on the table shows you the bear market threshold. Those are the threshold that usually signals to us once it's being reached, we are in the early stages of a bear market and recession. And right now, as of March, we have actually triggered all of these bear market threshold that I've pointed out. And usually when we have 100% a hit rate here within the bear market threshold from the bear market indicators, it usually will signal to us at least a good 6 to 12 months out of more downside in the equity market. And by this, I mean the global equity market, not just confined within the US market.
So in summary, the first part of this session can be wrapped up in 2 points. Number 1, this is a bear market rally which we should not be buying into. Number 2, if anything, we should use the rebound to cut losses on longs and take out downside protection.